There is one number on your child's school fee receipt that the school would like you to read. Then there is another, usually right below it, that quietly tells you what the school actually is. Because here is the fact almost no parent stops on. A private school in India is by law not allowed to make a profit. Sit with that sentence. Once it's true, the interesting question is no longer how high the fee is. It's where the money goes when no one is legally allowed to keep it. Start with the rule that shapes everything that follows. In most Indian states, a private school cannot be a company that earns for its owners. To get affiliation from boards like the CBSE, the Central Board of Secondary Education, or CISCE, it has to be run by a charitable trust or a registered society. All private, unaided schools in India, whether established by trust societies or private entrepreneurs, are registered as not-for-profit organizations or charitable under the Societies Registration Act of 1860 or similar state acts. So the courts drew a careful line. A school may keep a reasonable surplus for its own growth, but profiteering and capitation fees are forbidden. And crucially, that surplus cannot be delivered to the trust, to the promoters, or to any other businesses. In Modern School versus Union of India, the Supreme Court held that surplus can be generated, but must be used only for the benefit of that educational institution, and it cannot be diverted for any other use or for personal gains. That sounds like a wall around the money. Hold the thought. Because if profit is illegal and you can't pay yourself a dividend, here is a question to carry for the next 8 minutes. Why do so many people, politicians, builders, and business families want to run a school? Follow the money and you will see that what there is actually collecting. Lay out the schools aside fairly because most of it is true. The school is a charitable institution running in regulator's own words on a no profit, no loss basis. Your fee pays the teachers, the electricity, the maintenance, and the buses. Running a good school is genuinely expensive. In Delhi, the land alone to qualify for board affiliation can cost between 200 and 500 million rupees. And the courts back the school. Through 2025 into 2026, one judgment after another has held that an unaided school is entitled to a reasonable surplus for expansion, and the government can step in only to stop profiteering or capitation, not to micromanage a school that is running honestly. So the parent belief is reasonable. I am paying for a service and the institution is non-profit and the surplus stays inside. That belief is about to meet a number. Two facts the official version cannot comfortably hold. Fact 1 is on your own receipt. Below the tuition line sits a head called the development fee. The rules permit a development fee of up to 15% of the tuition fee, paid with Mandatory Depreciation Reserve Fund, a DRF, an account meant to set aside money as assets wear out. And what does that money buy? Buildings, furniture, smart boards, air conditioners, lifts. These are capital assets, that is physical assets. Now read what that means in a plain economic term. As one analyst of Delhi's new fee rules put it, parents are being legally compelled to pay for capital assets, buildings, and furniture owned by the society or trust. converting parents into involuntary investors who bear the cost of capital accumulation but receive no equity in return. Read that twice. You are funding the construction of an asset. You will never own a share of it. And there is no share to own because no one can buy a equity in a trust. Fact 2 is the regulator's behavior. Year after year, in state after state, the government has had to order schools to stop forcing parents to buy books, uniforms, bags, transport from one designated shop. In April 2026, Delhi Directorate of Education again directed private schools not to compel parents to buy books or uniforms from specific vendors, noting that as a charitable, no profit, no loss institutions, any practice that commercializes or burden parents is not permissible. Ask the banker's question. If there were no money in those designated vendors, why would the states keep having to ban them? That's the crack. Now, the architecture. This is the chapter the whole video exists for. One idea, named plainly. In normal business, makes a product, sells it, and takes the difference as profit. The front door is profit. For a school, the law has bolted that front door shut. So the money a business would take as a profit doesn't vanish. It reroutes through the doors that are still open. There are 3, and a banker recognizes each one instantly. Door 1, the asset, the development fee, and that the reserve fund quietly builds the trust buildings. Over 15-20 years, batch after batch of parent pays for an even larger physical campus, and the trust owns all of it. And notice the timing. The fee is collected upfront at the start of the term, before a single class is taught. It is the opposite of a kirana store, where the shopkeeper gives good on udar and waits to be paid. Here, the customer pays first, in full, and the institution sits on the pool of cash for months. In banking, we call that a float. Interest-free money you hold before you spend it. A school with 2,000 children is holding great deal of someone else's cash all year at 0%. Door number 2, the related party. Surplus can't be taken as profit, but it can be paid out as an expense. Rent to a company the same promoters own. Books, uniforms, transport, software, routed through a vendor connected to the management. The margin still leaves the building. It just leaves the wearing the label cost, not profit. That's why the regulator keeps banning the designated shop. It's the one door where the money walks out in plain sight. Door 3, the land. The trust is exempt from income tax. And it's very often sits on a land that was allotted for education, frequently at concession rates. The fee, service it and develop it. And the real wealth shows up not as money in the bank, but as the rising value of that land and campus, held inside a tax-exempt trust. Invisible as a profit, entirely real as net worth. Put these 3 together and the picture resolves. A school does not get rich on tuition. It gets rich the way an asset holding a company gets rich, by accumulating a tax-exempt, debt-light, appreciating base of land and buildings, funded by customers who believe they are buying a service. The non-profit rule never stopped wealth from being created. It only changed the door the wealth walks out. And to be precise about who is not the problem here, the bank simply holds the trust deposits and it reserve fund. The court and the education department are the ones trying to keep the surplus ring-fenced inside the school. That's the discipline in the system. The mechanism we are describing is not a crime. It's what happens when you forbid profit but allow assets. The incentive does the rest. So, what does this cost an ordinary family? After rent or the home loan, school fees are usually the single largest recurring claim on middle class household, and they tend to climb faster than salaries too. The parent funds capital assets and vendor margins they cannot see, cannot easily opt out of, and will never own a rupee of. Switching schools midstream means transfer disruption and fresh changes, so the parent stays. A captive payer by design. And then the sharpest twist, the one that runs straight through your world and the governments. The law reserves 25% of entry-level seats in private school for children from economically weaker section, the EWS quota under the Right to Education Act. The government is supposed to reimburse the school for these seats. On paper, state pays for the poor child education. In practice, the money runs years late and arrives partial. Reimbursement for over 3.1 lakh students across the 12 states went unapproved in single year. In Maharashtra, state audit reports point to the thousands of crores in pending dues. Tamil Nadu has gone to court over the withheld central share of more than 342 crore rupees. Individual schools wait years. So the school floats the gap. And the Center for Civil Society notes the cost of educating these students is often passed on through a fee hike to the fee-paying parents. Read that plainly. When the government is slow to pay for the poor child seat, the bill quietly lands on the next parent receipt. So the wall around the money had a gate after all, and more than one family is standing on the wrong side of it. So none of this means a good school is not worth paying for. It means reading the transaction the way the balance sheet does. 3 things you can do, none of which need a finance degree. 1. Read the receipt by head, not by total. Separate tuition, the operational cost of teaching, from the development fee and annual charges, which build capital from the earmarked levies like transport. Ask one question of each line. Am I paying to run the school or to build an asset I will never own? 2. Ask for the audited accounts and the depreciation reserve fund. A school that levies a development fee is legally required to maintain that fund. Several states now give parents the right to see audited statements and to challenge a hike. In Delhi, a group of 15% of enrolled parents can formally appeal to fee structure. A school confident its surplus is genuinely reinvested will open the books. 3. Decode the compelled purchase. If you are told to buy books, uniforms, or transport from exactly one shop, you have found a related party door. In a growing list of states, you are now legally free to buy from the open market. So price it and use that freedom. And one signal to watch. A trust that runs many things at once. Several schools, a college, a real estate, under the same promoters. The law forbids moving one school surplus into another venture. So concentrated cross holdings are exactly where the question should be sharpest. You walked in asking a simple question. Is this fee fair? The balance sheet was answering a different one the whole time. How do you build a tax-exempt, appreciating estate of land and buildings out of money no one is legally allowed to keep as profit? The non-profit label was never the limit you assumed it was. It's the design that decides which door the wealth uses to leave. So the next time you read that receipt, read it like a banker. The tuition line is the service. The development fee is the equity you're funding but will never hold. The vendor list is the margin. And the land under the playground is the real balance sheet. So the question was never whether your child's school makes a profit. It's what it is quietly accumulating in your child's name and whose name is on the asset long after the fees are done. I will see you in the next video.